Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Hello and welcome to this final installment of the Income mini-series on the Australian Retirement Podcast. If this is your first episode that you're tuning in for on the Australian Retirement Podcast, never fear because you'll enjoy this episode just even by itself. In this episode, we talk with Cameron Gleeson of Betashares ETFs about how to use ETFs to construct a simple passive income portfolio. In other episodes throughout this mini-series, we've heard from all different types of investors. Some of those investments that we may have spoken about are available in ETFs and some of them weren't. But this episode is all about ETFs. We also talk about the difference between an ETF and something called a listed investment company. If that's new to you, don't worry. We cover that in this episode. You should know that this episode features a slightly younger looking me because it was recorded a few months ago for our Australian Finance podcast, but it was so good and so popular, we just had to include it here in this retirement income mini-series. If you have any questions about ETFs, how to use them in a portfolio, how to study one, do financial advisors use them, those types of things, be sure to use the link that's available in the YouTube description, or if you're listening, don't forget it's in the podcast player. Select the link that says Ask a Question, and then the Australian Retirement Podcast. And James or Drew, your resident financial advisors, will answer the questions for you. Thanks for listening to this income mini-series and this final installment with Cameron Gleeson of Betashares.
Cameron, thanks for joining me on the show.
Owen, great to be here.
It's always a pleasure and good to chat in person.
In person. This is the first time we've actually met in person. It's unbelievable.
And we've spoken so many times, so all the better. Today we're going to be talking about a range of ETFs, but in particular, ETFs with an income focus, which is really important. 9 out of 10 of our community actually invest because of financial independence and income-related things. So I kind of group them together because for me and for most people, I assume that financial independence means income from an investment, whether it's a property or whether it's ETFs or the share market, whatever the case. The income brings independence, I believe.
Yeah, that's right. People often talk about passive income, and I think that's what they mean, that independence from having to rely on a salary to fund your lifestyle.
Yeah, so today we're going to talk about how ETFs can help people achieve that. And we've got quite a few different ETFs, and as we go through, the way I've lined them up is kind of in a way to challenge people's understanding of what ETFs can do, but also kind of articulate, get a little bit more complex as we go. Not too complex, but just to get a little bit more complex so people get a good rounded understanding. But some icebreakers first, mate. So I often ask a different range of icebreakers, but one of the things I went back and looked at recently was Warren Buffett once got asked as an icebreaker, show us your wallet, and just like all the things that were inside it. And I feel like a better way to do that in podcast format would be like, what's the most recent investment that you made personally?
Yeah. So the most recent investment I made personally was for Betashares HAC, which is our global cybersecurity ETF. I was doing some, research in terms of cybersecurity and obviously talking to some of the experts in the US that are involved in that fund at the NASDAQ. And, personally, I sort of looked at the fundamentals and I actually thought that's was at a really interesting place in terms of, valuations and earnings growth. So as a satellite exposure, I thought that's one that I could add to my portfolio to potentially add some outperformance, long-term structural trend and the like. Big fan of cybersecurity.
Yeah. It's just getting even more important as time goes on, right? So that was HAC.
HAC, yeah, that's right. Yep.
Okay, that was the most recent one. What was the first?
Yeah, so the first investment I ever made, share investment, was MIM Holdings, Mount Isa Mines, which my mum helped me buy. So I grew up in Perth, and our stockbroker, I think we did it over the phone or something. I can't even remember how much I bought, but that was sort of early 90s. And I think I made a slight profit. It probably wasn't very much money. Brokerage probably ate up about half of it, but that was my first experience. And I guess I was kind of interested in markets from that point onwards.
Yeah, it's interesting to see how rapidly the investment landscape has evolved, not just in terms of the types of investments that people are making as their first timers, but also how we access the information. Betashares, the team, your team and the team around you have just been moving so fast to innovate in the space. You mentioned HAC as an example of bringing those types of ETFs to market. But one of the things that we wanted to focus on today is ETFs for income. So can you just maybe just let's start the simple level, the highest level. Most people are familiar with the ETFs now, but in terms of the benefits just for using ETFs for income, what would they be?
Yeah. Okay. So, when we're thinking about building a portfolio, the great thing about ETFs is that there's such a wide choice of ETFs available. So you can get exposures to international shares, to Australian shares, to cash, to fixed income. And when you're looking to build that portfolio and sort of benefit from that diversified core, being able to pull from all these different asset classes is really important for ensuring that you can hold that portfolio over the market cycle and manage the level of risk or volatility. Now, within each of those asset classes, I talked about the choice in ETFs. There are funds that will give you access to, for example, global shares that have either like an income focus, or Australian shares, or indeed within the fixed income universe, there's ways that you can access higher yielding securities within that particular asset class. So it's really about that choice and being able to build the well-rounded portfolio at a low cost base. We know that ETFs typically have relatively low fees, and that's going to be better for ensuring that more of the income generated ends up in your wallet.
Yeah, that's great. So you've got choice, you've got kind of the ease of use, you've got the cost. I was interested in tackling a slightly different angle, and I think I've seen an article from you or somewhere someone was doing this, is like a lot of our older audience in particular, as well as some of our younger audience, are familiar with listed investment companies, or LICs as we call them, LICs in the lingo. Yeah, that's the thing. It sticks with you. But a lot of people compare an ETF because it seems similar in some ways against a LIC. And I know, there are many differences that are important distinctions, and one's growing a lot faster than the other. Can you talk about the maybe the similarities or differences that as you see them, and maybe as you answer that through like what a younger person would be thinking about versus maybe an older person who has familiarity?
Yeah. So, I mean, I think, for those that have used ETFs for a while and perhaps have experience with LICs, if you've been through a full market cycle, we can sometimes see the differences between these two types of investments quite clearly. One of the really good things about an exchange-traded fund is it's really a basket of securities investments. But because of the way that units are created or redeemed, it means that they will typically trade at their fair value. So if I compare that to a LIC, the way that a LIC works is essentially a fund manager or an investment manager will do effectively like an IPO or raise capital and have a pool of cash that they then invest in a portfolio of assets. But from that point onwards, the price at which the LIC trades is dependent on buyers and sellers in the market. There's no mechanism to ensure that the price at which it trades is the fair value of that underlying pool of assets. Now, some of the time that's okay. We'll often see LICs trade around about their fair value. But when you see dislocation in markets such as COVID, we saw, for example, credit LITs or credit listed investment trusts, which are a sort of a type of LIC, trade at discounts to the value of their underlying assets of up to 50%. So liquidity can dry up and dry very quickly in the LIC market. With ETFs, because of the mechanisms with market makers, if there is a discrepancy between the fair value and the traded price, that discrepancy will typically be closed very, very quickly. It would be considered an arbitrage opportunity. So you get fair pricing with ETFs, which sometimes you don't get in LICs. And I guess the other point to the LIC structure is that if I'm an asset manager and I've raised this money and I'm able to earn management fees from basically manage the LIC, it's really captive money. There's no competitive force compelling me to ensure that I'm really providing best value for money for underlying investors, because that money's trapped. There's no way that essentially the unit holders can redeem their units. Those units remain and must be sold to another unit holder on market. Whereas the ETF industry is an incredibly competitive industry. There are a lot of different ETFs that you can buy, and so any ETF provider worth their salt has to ensure their product is being run as efficiently as possible to the benefit of their investors. And if it's not, those units will be effectively sold on market and then redeemed, and the asset manager or the ETF provider will have a reduction in their FUM. So I think that competitive dynamic means that because the ETF industry is growing, which is great, but it's also getting very competitive, means that you are getting world-class product. Whereas the structure of LIC means that really the manager of that LIC has a captive amount of assets which they can earn revenue on into perpetuity. So it's not quite the same dynamic, and it can lead to misalignment, shall we say, of interests, as well as those dislocations we sometimes see in markets when liquidity dries up for LICs.
I might summarize a bit of that, if I may.
Please do.
In that, no, it was a wonderful explanation. But imagine you're sitting at home and you're listening to this, or you're watching it on YouTube. Imagine you've got an ETF on one side and a listed investment company on the other. When you buy the ETF, you're getting what's inside it. That's what's happening. You're getting what's inside it. But when you're buying the LIC, you could be buying it, like you said, above or below, sometimes at very big premiums or discounts. So in the case that you gave before, instead of buying what's the old cliche? You can get, $1 for 60 cents or something like that. You might be getting 60 cents for $1, which is not what you want. And so while they may seem similar, there are important differences. And now the kind of country is waking up to that and things are changing.
Yeah. It's also worth noting, sorry, just to elaborate there. I was looking recently, you can look at on the ASX website, they'll show you the discounts or premium that LICs are trading to NAV. And right now, the vast majority are actually trading at a discount. Now, that sounds like an opportunity to buy units because presumably at some point that discount will close. But we have seen that doesn't necessarily end up being the case. Those discounts can essentially exist into perpetuity if investors are willing to support that fund. So just because a LIC is trading at a discount doesn't necessarily mean there's an opportunity to buy there and that you will see a close in that discount. It's a very different beast. Yeah,
it's really interesting. And while it may seem that we're critical of LICs, and maybe that's fair, we both invest in ETFs, and for me, it's the overwhelming majority of what we do. So, that's where kind of the plates of this industry have shifted, like the tectonic plates have moved across, and we're kind of now seeing the light over there. But there's other reasons to use LICs. I would like to venture into the first couple of ETFs, if we may, and I'd like to start with cash ETFs. A lot of our audience are familiar with the AAA, the Betashares AAA cash ETF, and they often ask me, what does it do? How does it work? But let's just use that as an example to explain how an ETF actually generates income.
Yeah, a great place to start. So AAA is one of our largest ETFs. It's the Betashares High Interest Cash ETF. And it's a very simple ETF in many ways. It essentially takes investors' money and it invests them across a range of bank accounts. And the way the fund operates is those bank accounts all earn interest. And it's quite interesting. If you look at the on-market traded price, or the NAV, if you like, if you wanted to look on our website, of AAA over the month, you'll see this hacksaw pattern where at the start of the month, it ticks up every day. It's ticking up by the interest amount because the accounts with the bank accounts which the fund's investing in are obviously accruing interest. And then at the end of the month, it pays a distribution. So it pays out the interest that is earned on the bank accounts less the management fee of the fund. Now, essentially, the fund has been in existence for over 10 years. And because obviously we're able to utilize Betashares' institutional footprint, we're able to get very attractive rates of interest on those underlying bank accounts. And it's earned more than the RBA cash rate after its fee ever since inception. So it's currently yielding net a fee around about 4.45%. But we sort of think about that equation as what do the underlying bank accounts earn, less the fee, and that is paid out as a distribution. It's paid out every month because we know that people who invest in that would like to see the income from that. But it is very much a cash-like instrument in terms of the way it behaves.
Interesting. So that's a really good foray into ETFs. And it's through the simplest example is money goes into the ETF, Betashares puts it in bank accounts earn interest, that comes back to the investors.
Exactly right.
Simple as you like. Now let's take kind of like a slightly sideways step to an ETF that people maybe on this show at least maybe haven't heard as much about, which is trades under the ticker symbol MMKT. Can you talk to us about this? Feel free to juxtapose with a AAA or just explain it in its own right and what that does.
Yeah, so MMKT, which is an Australian cash plus fund, this is, if you like, a cash plus solution. So, AAA has been a very successful fund. It's very well supported. But what we wanted to do was offer a product that can be used as a cash allocation that earns a little bit more than AAA. Now, within the world of fixed income, there are a class of securities which are known as money market securities. These are essentially traded term deposits, traded bank accounts. There also include some very, very short-term bonds issued by very high-quality issuers. Now, institutions, when they're looking to invest their own cash allocation, will access these institutional markets to earn a little bit more than cash. And really what MMKT is trying to do is really package what's available in that very short-term, very high-quality market and provide that to clients as a cash plus solution. Now, if you look at the performance of AAA versus MMKT, you'll notice that MMKT earns just a little bit more than AAA. So I mentioned before the current interest rate on AAA is 4.45%, so a little bit more than the cash rate. If I look at the rate net of fee on MMKT, it's more like, I think it's 4.75%. So you're just getting a little bit more. It's accessing a lot of the same underlying investments in that there are things like term deposits in there, but a slightly broader mix, just to give people a little bit more oomph in terms of that overall income picture.
It's interesting because a lot of people are familiar with AAA. Maybe it's the catchy ticker symbol, maybe it's just the simplicity of it, but I like how we can kind of just take one slight step to the side and here's we're moving into the world of fixed income, slightly more understanding, but not too much. Now, I'm going to ask you with a couple of different ETFs around, and feel free to answer this for both AAA and MMKT, do you consider this a core or a satellite allocation?
Yeah, so both of those I would consider a core allocation. And, let's be frank, AAA has had a very long time in the market. It's been a proven investment. So for a lot of people, the difference in the yield you can get from AAA to MMKT may not be enough for them to look for MMKT. But for those that do want a bit of extra yield, if you wanted to have a cash allocation in your portfolio, you might look for MMKT in place of AAA for that sort of cash solution. Both of them obviously are daily liquidity, so you're not tying your money up. You're getting higher rates of return than cash. So they're both sort of very similar, but one's really a substitute for the other. And it's really a dependence as to, do you like the yield uplift that you can get that is available with MMKT versus the incumbent product AAA?
I like it because a lot of people don't realize their brokerage accounts don't pay interest, or if they're in an SMSF, they need somewhere to put some cash. Yeah. Family trust, maybe just different things, investment vehicles that you might just assume are going to be earning interest, but may not always. So I think that's a big reason why these have been so successful and will continue to be successful. Let's talk more about stocks. This is the number one thing I'd say that most people know ETFs for, because that's kind of that's like the big picture for most people in their portfolios. So we're going to talk about some different ones, but let's just talk generally speaking. We'll start at the top. How does our understanding of income from an ETF change now that we're using a share-based or a stock market-based ETF?
Yeah, so if you take, for example, just an individual share, like if you were to look at BHP pays dividends, ordinary dividends, twice a year. They go X around about February, get paid in about March, and likewise in the second half of the year, August and September. The dividend will have franking attached. And typically what will happen is if you're an Australian investor and you qualify for franking, at the end of the year, the grossed up dividend will be your income in terms of when you submit your tax return, and the franking credit is a tax credit, which is effectively a prepayment of tax. That's received in cash at those times of the year, around about March and September. The way that an equity ETF works, I guess I could describe it as a bit of a, almost like a fishing trawler in a way. A200 is a very diversified exposure to the Australian market. It's the largest 200 companies. And it's essentially, within its trawling net, just scooping up all of those dividends paid by every company within its overall portfolio throughout the year. And it pays quarterly distributions, so that income which is earned through all of those distributions is bundled up and paid once a quarter, March, June, September and December. At the end of the year, you'll also receive a distribution statement for A200, and that will tell you the amount of franking credits that's attributed to you. Now, because an ETF is a managed investment trust, that means that all of the tax consequences of the fund holding the underlying stocks are passed through to you as the investor. So you'll pay all the sort of tax, and you'll receive the franking credits, but you'll also receive the cash as a result. So it's, if you like, an ETF is a pass-through of, as we said before, when you reference, when you're buying ETF, you're really buying what's inside it. It's the same thing for the dividends. You end up getting your share of the underlying dividends and franking credits and all the things that are attached to it.
I like that idea of the trawling analogy. I hadn't thought about that. As a keen fisherman myself, I don't use a trawling net, but I love the idea of a wide net, right? And I think it was, I'm pretty sure we talked about this off air, but I think it was one of your articles from a while back where you showed all of the dividends paid on the entire, well, the top 200 Australian shares. You showed like all the dividends, and a big proportion of that at the time came from BHP and the banks and those types of things. But by using an ETF, you get all of them. So even if BHP's reduces a little bit and other companies grows, you get a bit of that, you get a bit more of that. And it just makes, I just think that's just the easiest way to get income from the stock market is via the use of an ETF, I just think. And then the tax statement, like a lot of people aren't familiar with that, but you get the tax statement around this time of the year. You start to get tax statements in the mail that make the tax reporting easier. So I really like that. But what would you say, because there was one ETF I wanted to talk about, which we have not talked about on the show, period, which is the QOZ ETF. So you mentioned A200, which was just like you cast the trawling net out and you get what you get. Like it's the biggest ones are in the net, right? And that's A200. But for QOZ, this does something different. And so this is, again, us taking a step to be a little bit more complex in terms of our understanding of how an ETF can go about things. Mm-hmm. What is QOZ? How does it work?
Yeah, so A200 would be described as a market capitalisation weighted approach to holding the 200 largest shares on the Australian stock market. So essentially you weight each stock by its size. Now, a fund like QOZ, which is the Betashares FTSE RAFI Australia 200 ETF, it's a mouthful. Is a fund that essentially takes another approach to weighting the 200 largest stocks in Australia. So rather than weighting by their market capitalisation or their size of those shares on the market, it weights by essentially their economic footprint. It uses a number of metrics of companies across Australia to determine how large these companies really are in terms of their importance to the Australian economy. And what's really interesting about this fund is that in doing so, with that methodology, what we typically see is it provides a higher level of income than the broad Australian stock market. So for income-oriented investors, we see QOZ, which is the ticker code, as a really elegant solution because it has had very strong outperformance since inception. It does also have, it sort of keeps up with markets in periods both up and down. It tends not to have a lot of deviations from market while also producing that outperformance. But importantly, the real kicker for those who are after a degree of income is that higher level of income than the broad market. So it is ticking a lot of boxes, and it's actually a really novel and interesting approach, I think, that frankly has been around for a very long time and has really proven itself over that time period.
Yeah, so it's called, what is it, fundamental
indexing. Yeah, so the way that the index works is rather than saying what is the market capitalization of all the companies in the market, we take 4 key metrics. One is the total revenue of companies over the last 5 years, the total cash flows of companies over the last 5 years, the total dollar dividends, and then the price to book value, which is a valuation metric. So those metrics are all used, and we determine, on a relative basis, who had the most revenue, the most cash flows, the most dividends, and who has the largest, book value. And, creating an overall measure of company size based on those metrics does a couple of things. Firstly, those metrics tend to be, if you like, less variable than often the market. So we often see stocks go through periods of bullish runs and then will sell off later. This tends to have a more static allocation to stocks on rebalance. A really good example of this would be if we look at the banks over the last year, the Australian banks, going back about a year ago, the exposure that QOZ had to our banks was slightly more than the market because the banks had slightly underperformed the broad market for a period of time. Now, especially at the start of this year, banks have performed incredibly strongly. I think CBA is up about 40% year to date. As a result, QOZ's methodology is to sell down the winners. Tends to have a more static portfolio on rebound. So it's been selling down the banks as they've performed strongly, but it's participated in that upside run in the banks. So that's part of the reason why it's driven that strong outperformance, is the ability to not only participate in winners, but sell out of them and rotate into other stocks, which are a little bit cheaper relative to their economic size, if you like.
That's interesting, because a lot of people that understand the way ETFs go, built with the market capitalization framework, they know that it's basically the total value of the shares that are in that company. But that's not always the right way to think about what is the biggest and what is the most valuable company.
Yeah, that's right. So this is what you might call a smart beta or intelligent indexing approach. So, ETF started with that broad market capitalization approach for equities, and we've obviously moved well beyond that. There are active ETFs, but there are also, if you like, these sorts of smart beta approaches, which are designed to capture value or the potential to outperform using a different rules-based methodology. And obviously, because it's rules-based, it is still an index, so it is still something which can be provided very cheaply to investors in terms of the management fee, rather than an active manager, which will typically have a higher level of fee.
How do you see people using QOZ? Is it a core or a satellite in your opinion?
So in my opinion, it's an excellent core exposure. In terms of models that we are custodians for, we actually include this fund within the core. It does tend to have, technical term, but a low degree of tracking error. So it doesn't tend to have periods of massive deviation from the overall market, while it has also, doing that and also producing grindingly higher outperformance is really strong. To take another example of maybe another income-oriented fund that I'd consider a satellite, we've got a series of funds which are called the yield maximiser funds. One of them is our Australia Top 200 Yield Maximiser Fund. Its ticker code is YMAX. It's a very popular fund. It's a fund that produces a very high level of income. So that fund has got a gross yield of around about 10% per annum, which is much higher than, say, QOZ, which has about 6.5% per annum, and the broad market's more like about 5% per annum. So YMAX, I sort of think of as a fund that is going to give you that supersized income if you need that step up, but it will deviate a bit from markets depending whether we're in bullish or bearish market conditions. So QOZ very much sort of stick to the core. YMAX is going to give you something different. It's going to give you a step up in income, but it will have periods of deviation from broad markets.
Interesting. Okay, I've got this is the final kind of bucket I want to go fishing in, if we continue to butcher that one from me. But if I think about it, we've covered cash and we've covered shares, and as well as a few different variations of what those could entail. But there's obviously this other part of the market which people in ETF land are becoming much more comfortable with. And it's not just financial advisors that are using these anymore. A lot of our community are using these. And you touched on it before with MMKT about fixed income. And you and I have done videos before and things explaining the differences. But there's an ETF in the range called BSUB, BSUB. Can you explain that strategy from a high level, what it is, and then we'll go into where does it sit and how does it actually work?
Yeah. So just taking a step back, I think one thing that's clearly changed in the last couple of years when we look about, what we can access to generate a level of yield. It used to be that Australian equities were at the core of most people's portfolio that needed to generate income. Typically, the cash dividend yield was over 4% outside of periods like the COVID recession, but generally you're expecting a cash yield of about 4% plus franking. What we've seen in the equity market is that yields are actually fallen pretty substantially. So the broad market yield is around about 3.6% cash yield. It's much lower than it used to be. A share like CBA, for example, its yield used to be up around 5% and now about 3.5%. It just tells you that there's been an erosion of the amount of yield you can necessarily generate from equities. Fixed income has done exactly the opposite. We've obviously come off the floor in terms of rates. So a fund like BSUB has a yield of around about 5.7%. So that's interesting because you've got an asset class in fixed income which is lower risk than equities, which is giving you a higher level of yield.
Doesn't seem right.
But what the trade-off is there is obviously the equities you hope to also make capital growth. So there it does make sense. And historically, we have seen markets, and if you look at, say, for example, the US market, where equity yields are lower than fixed income. But I think what's really interesting is if we sort of look at fixed income, Betashares has, perhaps been a leader in this space. I like to think we certainly have the widest range of fixed income ETFs. We have the most assets under management. One of our most successful funds in this space is HBRD, which is it's an actively managed hybrids fund. It holds hybrids, but other bank capital securities. The yields that you can generate in fixed income are now much higher, but there are also different parts of the fixed income market you can access. If we think about hybrid securities, they are essentially a step below or a step above cash in terms of security. They act a bit like a bond, but in dire circumstances, they can be converted to shares. Above that, you have what are known as Tier 2 securities or subordinated bonds. So these are bonds that are issued by banks. And then above that, you have senior bonds, and then you have cash. So if I think about some of the products in our suite, cash is essentially the most secure liability that a bank will have. And that is what you're accessing through AAA. We have another fund called QPON, which is your senior bonds, so QPON. The step below that is BSUB, so that those Tier 2 bonds. These are securities that give you a great yield. I mentioned that before. About 5.7 is the current running yield, but they are not in the position where they'll be potentially converted to equities like hybrids. So it's really a question as to how much risk do you want to take and how much yield do you need. But in terms of that sort of trade-off of yield versus risk, I think holding a portfolio of Tier 2 bonds issued by our big four banks, who are regulated such that they are unquestionably strong and hold extremely solid capital buffers in terms of their Tier 1 capital, I think it's a really interesting and I think quite a valid investment you can make in your portfolio to increase the level of yield from fixed income, which previously we didn't used to use to generate income. So it's just being able to pull these levers across both equities or indeed now fixed income to boost your overall yield level.
One of the things that I try and do, and I know Kate tries to do it, but all of our hosts at Rask try to do, is we try and extend the knowledge of our community every time we do a show. And I love the way that you explain that. For people that aren't watching, Cameron was using his hands to demonstrate like the waterfall of like different levels of, the bonds, and also like from cash down and the different levels of income. And when you go down, you get higher yields, but it's often perceived to be more risky and so on and so forth. But it kind of illustrates something that's really important for particularly people that are focused on income, retirees, people seeking financial independence, all these types of people, which is that you don't just need to use shares and you don't just need to use cash. You don't just need to use property. I mean, most people don't use property for income, like residential property at least. You don't just need to use them. There's this whole like smattering of things that sit between at different levels of the spectrum. And ETFs have made that part of the world much more visible. And for the first time, you can get it in the same place where you can access all those other usual things that you would be familiar with. So you've kind of taken us on a journey from like the very basic constructs of what is an ETF, from cash, then we extended it with MMKT. We talked about A200, which people are familiar with, just the standard 200 Aussie shares. Then we go into QOZ. You mentioned YMAX. You mentioned the different levers as we go down. And now we've looked at the other side, which is like the bonds and the fixed income side of the market. And so you really can build a full portfolio, no matter what stage of your life cycle and your interests and whatever. And I'm seeing more financial advisors. I know you speak with them all the time, but financial advisors adopting ETF-only portfolios. And it makes sense now to do that because there's so many on offer. They're well-regulated, so on and so forth. I did realize I didn't get to one question about BSUB.
Yeah.
Do you consider that core or satellite?
I absolutely would consider this core. I mean, we talk about this, but when I sort of think of core, I'm thinking of exposure that I'm comfortable and want to be holding over the cycle. I think that the quality of the bonds that are included within BSUB's portfolio is such that it's absolutely a core part of my portfolio and the way I think about building a portfolio.
And fair enough, I would agree that these are, and when we say core and satellite, for anyone that's listening or watching, we don't just mean it's like all or nothing. These are part of a diversified portfolio.
Yeah, that's true.
You don't have to just choose one or the other. You can add them all together. That's the beauty of them. And I will put links to every single one of the funds that were mentioned in today's show in the show notes for anyone that's interested to go and learn more. There's heaps of literature, obviously full transparency on the website as well. Another feature of ETFs we didn't really touch on before, but that's one of the great things. I wanted to end with just a real quick question here at the end, which is just around that core v satellite type thinking.
Yeah.
And just how, like, if you could summarize it in some way, you've done a great job so far, but if you could summarize it, people are sitting at home, they're reading about an ETF and they're thinking of making an investment, how you think about, some type of basic framework toward, is this something that goes in my core? Is this something that maybe is in a satellite allocation I treat?
Yeah. So, when people are approaching building an investment portfolio, there's a few decisions that you need to make. The first is, how actively engaged you want to be in this portfolio. And for some people, that might be that they want to be, disengaged entirely. They just want to be able to, relax and know that their money is going to click along. For other people, they might want to be more engaged. And that's where the core satellite approach, I think, works. If you do want to take active positions or express a view in your portfolio, separating out some of your money as a satellite from, if you like, core, which you leave relatively untouched throughout the cycle, I think is really useful, because the point of a core really is to build a set of investments that you can hold over the long run. You don't want to, have to trade in and out of those core positions, because as we know, trading does result in tax consequences, CGT and the like. So it's really about holding diversified, low-cost investments that are going to be robust over the cycle and that work well together. We talked a little bit about that, but by combining different asset classes, we can get the benefits of diversification across individual funds. So certainly, funds that have that low cost, that high level of diversification can be really important. And then, if, for example, my views on the markets end up being wrong, maybe I've done some damage to my satellite allocations, but I know that core will be performing as expected and will compound over time. So that's just one way to think about building a portfolio. If you do want to be actively involved, and the benefits of having that core to keep you on track, to make sure that you don't, throw the baby out with the bathwater if maybe things go against you. Or indeed, perhaps if you're not necessarily interested in being overly engaged, a core might be all you need.
I like that, because it is so much of the conversation that I have is people do want to find out, what is core, what is satellite, and many of them just go, you know what, I'll just build this core portfolio, dollar cost average, just transfer that money every month, invested, done, job done.
Yeah.
I'll check in, every now and again, and that's wonderful. But some people, like you said, do want to take that kind of scratch the itch approach. I want to understand, what is this thing? Maybe what is hack? And I'm new to cybersecurity. Can I make an investment? How do I do that? And so on and so forth. So thanks for taking us on this field guide of ETFs and ETFs for income, mate. I know it's going to be really popular because it is like the thing that people want from their investment portfolio. So I really appreciate it. And thanks for taking a trip across the street.
Yeah, thanks. Always great to chat with you. And great to do it in person finally.
Thanks, mate.
Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.